Hi, accounting class. Welcome to the chapter 3. This is over the adjusting process. Today we're going to look at journal entries that have to be done at the end of the accounting period. Before we begin, we're going to look at two different types of way to do accounting. One of them is GAAP, one of them is not GAAP. The first one we're going to talk about is not GAAP, so this one's not as important. So cash basis of accounting is not the GAAP method. We can talk briefly why they prefer accrual accounting instead of cash basis in a bit. But under the cash basis of accounting, cash revenues are recognized when the cash is received. Expenses are recognized when the cash is paid. So it all centers around the cash changing hands. But there are serious limitations to this, and it's not the definitions I want you to know. When I ask for the definition of revenue, I don't want you to say revenue is recognized when cash is received. These are the definitions we can pretty much forget unless the problem explicitly says under the cash basis of accounting. We're not going to emphasize it because this is not the GAAP method. Alright, the one we're going to be using throughout this chapter is the accrual basis of accounting. These are the definitions we should know. Under the accrual basis, revenues are recognized when they're earned. That means we completed the service or we've delivered the good. We've earned the revenue. At that point, it's revenue. It doesn't matter when we get the money. It matters when we earn it. When we complete the job or deliver the good to earn the money. That's when it's revenue. Expenses are recognized when they're incurred. Again, not when they're paid. So if we're running a factory and we have electricity, it's an expense in the period that we consume the electricity. It's not an expense in the next month when we pay the bill. So expenses are expenses when we incur them. When we use up a resource, it's an expense. And it's an expense when we use up the resource, not when we pay the bill for that resource. Alright, it says that their business operates and earns revenue, they incur expenses, right? So we try to chase after revenue, and then as a result, we incur expenses. We have to pay people, we have to buy supplies, all these other different types of expenses, buying a building or a place to rent, all these other expenses related to running our business. But we're only paying those expenses because we're trying to earn revenue. We hope that we earn more revenue than the expenses so we have net income. Otherwise, the business is not likely to thrive for long. But there's another concept out here called the matching concept. It just says that we should match together revenues and expenses in the same period. This gives you like a fair scorecard. We can look at their performance for January, February, or for a quarter, or for a year. And we can see how they performed if we put the revenues and expenses in the right period. It gives us basically a fair scorecard of their net income or their net loss for that period. All right, and it's very important, this is the GAAP method. So this is the one we're going to be using throughout the rest of the course, and we have to use if we're a company, a public company that issues financial statements. It's required to use the GAAP approved method, which is the accrual basis of accounting. All right, why is it like the accrual basis and not the cash basis? The short answer is that accrual basis gives us better predictive value. Ultimately, we're preparing these reports for users. Users are going to make decisions based on this data. And what they're trying to decide is, if we're loaning this business money or if we're investing in this business, is this business going to do well enough to make this investment worthwhile for us or not? So they want information that allows them basically better predict the future. And accrual basis is going to give them better information that allows them to predict the future better than the cash basis of accounting. But this is more of an intermediate accounting concept. But predictive value is definitely the reason why GAAP prefers accrual basis and not cash basis of accounting. Alright, the major focus of this chapter is the adjusting process. It says in the previous chapter we recorded journal entries that originated from transactions. But it says some are not driven by transactions. So we're not going to see transactions here. We're just going to see the passage of time. The passage of time itself changes some accounts. So these are called adjusting entries. So adjusting entries basically get accounts up to date. We look at them at the end of the month and adjust them to get them to their appropriate balance at the end of the month. They're not transaction driven. They're usually driven by the passage of time. We're going to look first through some generic entries, and then later we're going to see specific entries for Paws Claws, the business we're following throughout this text. Here's just an adjusting entry always affects at least one balance sheet account and one income statement account. As we see them, they're all going to meet this criteria. Also in this chapter, chapter 2 is very hit cash almost in every other transaction. Chapter 3, we're not going to see cash hit one time at all. So if you're in chapter 3, cash is never affected. All right, let's go and get started with this. The first one is adjusting for supplies. Supplies is technically a prepaid expense because we pay for the supplies first and then we expense them over time. In our textbook, we're going to assume when we buy supplies, we're going to capitalize them as an asset, the supplies asset, and then we're going to expense them as we use them up. Now, realistically, a business that buys supplies, usually supplies are immaterial. They're small in nature. They're not a big amount of their expenses, so they just expense them right away. It's immaterial. It's okay to do that if they're immaterial. We're going to treat it this way because there's other things that a business might do, like prepaid insurance and other prepaids that are material to a business. So we're going to see the same life cycle for basically these first two. So in our class, we're capitalizing the supplies and we expense them. That's theoretically the right way to do it. Practically speaking, if they are immaterial, it's okay for a business to just expense them all right away. But we're going to do the theoretical right way. So 131, we had 1,200 supplies on their books, but we actually count them at the end of the month, and we only have 400 left. That means we must have used up some of the supplies, right? The amount we used up is going to be equal to the difference. So it'll be 1,200 minus 400, so it'll be $800. Okay, we generalize the amount that we've used up. We do not generalize the beginning or ending balance. All right, now we got to think about what two accounts are affected here. Effectively, what we're doing, we have this 1,200 in our supplies asset account, but now we count it, realize we don't have that many supplies, right? So we need to move it out of the supplies asset account. So I'm going to credit that account. Remember, it's an asset. So I credit the asset to reduce it. Assets have a normal balance, but you credit them to reduce them. It needs to go then, effectively, it's an expense. Anytime we consume resources, it's called an expense. So in this case, it relates to supplies, so we'll call it supplies expense. But anytime you're expensing supplies, it's going to be these two accounts, supplies, expense, and supplies. It's transferring it out of the asset supplies account into the expense account for supplies, showing that we've used up $800 of supplies. Getting our supplies asset account then would be adjusted down to $1,200, would be adjusted down by $800 and be at $400, which matches the reality of what we actually have in supplies. All the adjusting entries occur at the end of the month, so all the dates here are going to be 131. All right, this one's a prepaid expense. Supplies are, and prepaid insurance, prepaid rent, all the things that start with prepaid are also in this category. So supplies, we're going to see a very similar entry here. We just got to change a couple words. So here they purchase a 1-year insurance policy for $24,000. Go into the calculator. So $24,000. We want to do this only for 1 month. This is a 1-year policy. There are 12 months in a year, so I'm going to divide it by 12. You get $2,000, so it's going to be $2,000 per month, and we're only going to expense 1 month of it. So we're going to see $2,000 be the amount. Very similar here. We recorded this as prepaid insurance initially in Chapter 2, or the business would have recorded it that way. So we need to take it out of the prepaid insurance account, and it needs to go to an expense account. Since it relates to insurance, we will call it insurance expense. But very similar. Here we took it out of supplies. It hit supplies expense. Here we're taking out of prepaid insurance, the asset account, and we're hitting insurance expense. But anytime you do the accrual for insurance expense, it's always for insurance, it's insurance expense, prepaid insurance. Again, we're recording the amount we've used up. We're not recording the $24,000. We're recording the amount that we've used up. You have to read that it's a 1-year policy. And then we divide by 12 to get the monthly amount. All right, now we'll move on to another category called accrued expenses. These are accrued expenses. The word accrued just means it's built up over time and hasn't been settled with cash. So we haven't actually paid these. These are employees that have worked for us a few days, and we haven't paid them yet. Their payday might end up in the next period, right? So this is going to end up January, and then their paycheck won't be issued until the end of the week, which occurs in February. So here's the problem. So this is a 5-day work week. Total wages for the week are $10,000. So we know it's 5-day week. 10,000 total. This ends on a Tuesday, so we have to think about our calendar. It's 5-day week. It's Monday through Friday. So these employees are going to work for us Monday and Tuesday of the week, and we're not going to pay them until Friday. So let's get our calculator. We got 10,000 total. We're going to divide that by 5. That's how much they're getting paid per day. They're getting $2,000 per day. So they're going to get $2,000 for Monday and then another $2,000 for Tuesday. So we're going to multiply it by 2. And 4,000 is the amount we need to accrue for. The workers have earned 4,000. They worked for us in January. We owe them this money. They're not going to get paid until their normal pay date. We don't pay them early just because it's the end of the month. We do the accounting this way because payroll is just going to pay them on Friday. They always pay them on Friday. All right, so we need to know what accounts we're going to hit here. Well, we owe these employees money right now, so we're going to call this one wages payable. It's just like accounts payable, but we know it relates to wages, and wages are usually a big expense for a company, so we just call them wages payable. You might see salaries payable somewhere. To me, it's the same thing right now. So we're going to hit wages payable, and then the other side has to be some type of expense. In this case, we'll call it wages expense. But here we see we're accruing for their wages. We have 4,000 of wages that have been earned by employees, i.e. they're an expense to us, the corporation, so we're recognizing that expense. We're not paying them early, so we don't hit cash. We're going to hit a payable account, in this case, wages payable. And all the adjusting entries are at the end of the month. You can see the calculation. I'll just show it, what we did on the calculator. The total amount divided by 5 divided by 2, or times 2, I meant to say. Move on to the next one, another accrued one, right? So these are going to go and these are going to look similar. They're just going to have different names, but they're going to look similar. This time it's accrued interest. This is interest that we have incurred, but we haven't paid yet. This interest is incurred, so we owe it to somebody, but we're not going to pay them until this note actually comes due. But we still owe it to them. So we have to recognize that expense. We've effectively consumed resource. We've consumed cash in this case. The fact that we're not going to pay it until the future isn't relevant. The fact that we've consumed it or we owe it is now relevant. So we need to put this into a payable account. Since it relates to interest, we'll call it interest payable. No, it's very similar. That one's wages payable. This one's interest payable. And very similar, instead of calling it wages expense, we're just going to call it interest expense. The amounts given to us. There is a calculation for calculating interest. We'll see it in a later chapter when we talk about notes receivable. But yeah, both of these, you should see similarities between these two. Wages expense, wages payable, interest expense, interest payable. Notice just the wages or the interest word changes. They're very similar because they belong to a group called accrued expenses. Now we're going to get to the third type, accrued revenue. Just like accrued expenses, expenses that have built up over time and haven't been settled with payment. Accrued revenue is the same way. These are revenues that we've earned but haven't received payment for them. It doesn't matter that we haven't received payment, though. It matters that we've earned it. Since we've earned it, we get to recognize it as revenue. So we perform service in a month equal to $12,000, but they have not yet received the cash or recorded this transaction. So we need to record it in our books. We've earned the $12,000. We need to recognize it as revenue. So we're going to hit whatever fees earned or some type of revenue account, whatever the business is using. In this case, they're using fees earned. And then we're not receiving this in cash, right? But they owe it to us. We've earned the money. They owe us the money. We expect them to pay us the money. So we put it to accounts receivable. Yeah, if you're going to do this on the homework, I don't put the dash. I'm going to go and change that to just AR without the dash. So if you're reading it, taking the shortcut in the homework. But very important here, we're doing this because we've earned the revenue. Because we've earned the revenue, we recognize the revenue. We just put it in the AR right now because we haven't received the cash. So it all goes back to our definitions of revenue and expenses, why we do each one of these entries. Because expenses are expenses when they're incurred, revenues are revenues when they're earned. It has nothing to do with the cash being received. Here we're going to see another accrued revenue. This time it's for interest. It's going to look quite a bit different from this accrued expenses. In this case, we're the one who owed the interest to another party. And the one down here, we're the one who holds the note and will earn the interest over time. So in this case, it's $50. I give you the amount. There's no calculation. This is revenue. We're going to call it interest revenue. So we're recognizing that we've earned $50 of revenue. We're not going to receive it yet. They're not going to pay us until the note's due, but we've earned it, so we're going to put it into interest receivable. But see the relationship here? Instead of accounts receivable, it's interest receivable. Instead of fees earned, it's interest revenue. So it's a revenue account on each, and it's a receivable account on each. All right, the next type, we got two more different types here. That's the third one. This will be the fourth one. This depreciation will be the fifth. So there's 5 different types of adjusted entries. All right, generic entry, unearned revenue. So remember, unearned revenue is when we're paid in advance for a good or service we have not yet delivered. So a customer pays us cash in advance, and we have not yet provided the good or service. We will, over time, provide that good or service. And it makes that $12,000, the amount we report to unearned revenues, a liability. Remember, this is a liability account. So this is the initial transaction. We're not reporting the initial transaction, though. If we did, we would what? Debit, cash, credit, unearned revenue. This is what you kind of think how they initially record it. But we're not recording the initial entry. We're recording the adjusting entry that occurs at the end of the month. So this is $12,000. We were paid in advance, and they paid us in advance for 3 months of service. So effectively, each month we're going to earn $4,000 of this. And that's what we're going to recognize here, $4,000. What we want to do is recognize this as revenue, so we're going to put this to fees earned or any other revenue account that's given in the problem. We need to take it out of somewhere. We got to think how this was initially recorded. This was initially recorded to unearned revenue. So when we take it out of unearned revenue. Remember, unearned revenue is a liability account, so debiting it reduces the account. But effectively, we're taking the amount out of unearned revenue, the liability account, and putting it into an actual real revenue account because we've earned that portion of the money. So you kind of get to its name, unearned revenue. It's not a revenue, it's a liability account, but they call it unearned revenue because it's like when it grows up, it's going to become a revenue, right? As time passes and we perform the services, deliver the goods, it's going to become a revenue. So they're just not revenues yet until we earn them, but once we earn them, we do expect this money to become revenue. All right, the new type, the last type, depreciation. Depreciation is its own category. There's a little bit we're going to talk about to introduce this concept. It's the first time you've seen it. So we're talking about fixed assets. Fixed assets are also called property, plant, and equipment. These are assets that have a long life and are used in business operations. Examples here are land, building equipment, machinery. These are all examples of fixed assets. So these fixed assets last for a long time. They last definitely more than a year. But they could, buildings can be 30, 40, up to 50-year life. But fixed assets do not last forever, except for land. We don't depreciate land. But all other fixed assets we depreciate. Depreciation is recorded as using up of the asset over time. Just like if we have a car. You use a car for 5, 10 years, whatever time it works for you. And then over time it loses value because you use it up. It's not going to last forever. Things are going to quit on it. It's going to be a new engine, new motor over so many times, new tires, oil change, different things are going to make it lose value. So accounting, we recognize that fixed assets lose their value over time and we record depreciation for them. Now you have to be careful if you take in economics. They define depreciation as an actual market loss. In accounting, we don't. We live in our own world. So we define this as a systematic using up of an asset over time. So we just apply it to a formula. This has nothing to do with market values. All right, so we're going to see an example here. We're going to take a vehicle. Has an initial cost of $20,000. Has a residual or a salvage value of $2,000. That just means at the end of its life, we bet we can sell it to somebody for $2,000. And it's expected to last for 5 years. Residual value is the value the asset will have at the end of its life. Here's the formula for straight line depreciation. You don't need to remember this yet. If I do anything in this chapter, I'll give you the formula. I think you do have to, on the homework, you have to plug things in, but you can look at the notes. I'm not going to have you define depreciation without giving you the formula yet, so I would just know how to work this. In a later chapter, we're going to look further in depreciation, see other methods, and then you'll know the formulas. All right, so we just plug things in. We have to be careful if we're on a simple calculator. So we kind of have to do this in order. You have to take the initial cost, $20,000, minus the $2,000 residual. Press enter, you have $18,000. Now you want to be careful here. You need to use parentheses if you're doing the 5 times the 12. Effectively, it's 60 months. We're putting this in monthly terms, and you get $300. But just be careful, you do need those parentheses here, or the simple calculator will not calculate it correctly. No calculator will. So parentheses are important. Again, 131. All right, depreciation is always just two accounts: depreciation expense and accumulated depreciation. Depreciation expense and accumulated depreciation. That's always the adjusting entry for depreciation. It never changes. It's always depreciation expense, accumulated depreciation. Here we get to two accounts that are related. One of my colleagues, when we're making this, said it would be nice to show them like they're in a relationship, because you should always see these two accounts together in your mind. So a fixed asset and its accumulated depreciation account are always, even if you see them on a balance sheet, they're always together. So anytime you think about these accounts, you should think about it together, especially when we get to Chapter 8, talking about fixed assets. We're going to think about its accumulated depreciation. So they're like they're in a relationship together. So always think about a fixed asset and its accumulated depreciation together. Let's talk about more about accumulated depreciation. This is something strange. It's called a contra asset. All right, contra asset. A contra asset is an account with the opposite of the normal balance. So we can think of this like this. It's a contra asset. We can almost think of this as a negative asset, right? When we see it on the balance sheet, it will subtract. We're going to have the fixed asset, would have this vehicle on our books for $20,000, and under it would have the accumulated depreciation. In this case, it's only 1 month's gone by, it'd be $300. It would be a negative $300. We would subtract it out of the $20,000. We would do that to get to its net book value, a term called its net book value. All right, but going back to contra asset, opposite of normal balance. So an asset normally has a debit balance. A contra asset will have the opposite, or a credit normal balance. You can also think of it like a negative asset. It's a negative asset. It's stored with the assets. It's stored right under the fixed asset, but it has that credit balance because it's a negative asset. We're going to see other contra accounts throughout the course, so it's just helpful to get that definition in our mind. It's the opposite, or negative. Net book value, the original cost minus accumulated depreciation. Notice this accumulated depreciation is going to grow, hence the name accumulated. So it's $300 right here for the first month. Second month it will be 300 more, so it will be 600. Next month it will be 300 more, it will be 900. So this accumulated depreciation is growing over time. Asset cost is always going to stay at 20,000, the original cost, but the accumulated depreciation is growing by 300 per month. So the book value will be going down over time as this number grows and is being subtracted. That book value will decrease over time, and so to start at 20,000 and decrease over time, effectively hitting the residual value at the end of its useful life. All right, now we're going to look at Paws and Claws. To start off with, we're just going to summarize. We've looked at 5 different types. If we have an accrued revenue, we debit a revenue and credit. Sorry, I said it wrong. If we have an accrued revenue, we debit a receivable account and credit a revenue account. And if we have an accrued expense, we recognize that expense by debiting it, and we put it into some type of payable account. Let me go and give you an example. Accrued revenue is like AR, fees earned, or interest receivable, interest revenue. Accrued expenses would be the wages. So you'd have wages expense, wages payable, or the interest expense, interest payable. Unearned revenue kind of gives itself away. We have unearned revenue, so we have to debit unearned revenue to remove it out of that account and actually move it to a real revenue account. So moving it out of a liability account into an actual real revenue account. That one always involves unearned revenue. Prepaid expenses, the examples are supplies. So if we're doing supplies, the adjusting entry, we're going to debit supplies, expense, credit, supplies. If we're doing prepaid insurance, we would debit insurance expense, credit prepaid insurance. If we're doing prepaid rent, we would debit rent expense, credit prepaid rent. So you can see there's a pattern once we can label it as a prepaid expense. And all of them start with prepaid except for supplies. Supplies is a prepaid expense, though. No one just called it. It would be appropriate to call it prepaid supplies. It's just I've never seen it called that. It's just kind of implied. All right, depreciation. Depreciation is the odd one, but it's always the same thing. It's always depreciation expense. It's always accumulated depreciation. So it doesn't change. You'll get used to it. But I understand that these are, especially accumulated depreciation, it's hard to say at first, but it's just something to get in your mind. Good news is it doesn't change. It's always that entry. So just get it in your mind. All right, we're going to do this for Paws and Claws. We're going to see the different ones. They have transactions that are going to require us to do adjusting entries. Remember, they bought that prepaid rent. They hired workers. The workers are going to work, and we're going to owe them money at the end of the month. They bought prepaid insurance. They have some unearned revenue when they were paid in advance, and they have the interest. Should be a 6 here, but it's not showing up for depreciation. In addition, there's going to be another one for revenue for the month, 2,150 for that, and then 3,000 for veterinarian. So we have two different types of revenue. The first one's grooming revenue, and the second one's veterinarian revenue. And then we're going to record taxes. Probably not going to see the taxes one anywhere, but it's in the notes, so we're going to cover it. They have a tax schedule here, but don't worry, they're going to fall in this first category. So really, we're not going to get to the complexity of the tax schedule here because it doesn't fall into that one of the higher ones. But in the payroll chapter, we see another form like this, but I don't know if we're going to cover the payroll chapter this year. All right, so let's go and do this. Prepaid rent. Janet prepays $9,000 office rent for 3 months, so we need to figure out 9,000 divided by 3, 3,000 per month. We're going to move that. This is a prepaid asset. We initially put it into prepaid rent. Now we're going to call it rent expense. Uh-oh, it's wrong. The date's wrong. No, it's not. It's 131. Sorry. All right, rent expense, prepaid rent. We're moving it out of the prepaid account into an expense account. We've used it up, right? We've used up one of those 3 months. All right, I'm going to show the amount that we've already talked about. 9,000 divided by 3 gets you to 3,000. All right, this next one, it's helpful to use a calendar. All right, when did we hire these? We hired them on the 8th. They're going to work for 2 weeks, and we paid them on the 19th. So we've already accounted for this section, this pay period. We started on the 8th. We paid them on the 19th. They're working bi-weekly. What's going to happen on the next period, though, if we just imagine this is the first week, this is the second week, so we have February 1st and February 2nd right here. But our month ends on January 31st, so we're going to owe these workers for 1, 2, 3, 4, 5, 6, 7, 8 days. 8 out of the 10 days of that period are in January. So we need to accrue for 8 tenths of the total. 10 total days. 1, 2, 3, 4, 6, 7, 8, 9, 10. 10 days, but 8 of them occur in January. The other 2 occur in February. So we need to account for 8 of the 10 days. 8 days in January that we need to accrue for, and there's 2 days in February, and they'll be paid on February 2nd. So our objective is just to accrue for the 8 days that occur in January. So we're going to take the total amount, we're going to add up 2,500 plus 1,800, and then divide by 10 and multiply by 8. So 2,500 for one of them, Karen, and then we have 1,800 for Paul. Add those up together. Make sure you use the parentheses or you add them up first, because without the parentheses it changes it. Like if we remove these, that's not the same thing because the calculator is going to do this part first and then it's going to add 2,500 to it. All right, so if we do that math, we get to this number, which is 3,440. Let's go and calculate it to show you. So if we're using a simple calculator, take 2,500 plus 1,800, add those up first, then multiply 300 times 8 divided by 10. There's 2,500 plus 1,800 times 8 divided by 10. There we go. So yeah, just split it up in a simple calculator if you have it. This is completely right if you have like a graphing calculator. You can enter it exactly like it's written here. Let's go back to the 2 accounts. It's wages. We should know by now it's wages, expense, wages payable, right? Wages, expense, wages payable. The only more difficult part here is the amount. All right, prepaid insurance. Hopefully, remember from the adjusting entries, it's insurance expense, prepaid insurance. Any prepaid asset is going to debit an expense account, credit the asset account. What $12,000 covers the firm for 3 months. So we're going to take 12,000 divided by 3, which is 4,000. Unearned revenue. Here we need to get it out of the unearned revenue account. So we're going to debit the unearned revenue account and credit an actual revenue account, probably whatever revenue it is. Grooming, which one is it? Grooming pets. So it's grooming revenue. 9,000 divided by 3 is 3,000. After this entry, notice this will reduce the 9,000. There's only 6,000 left, which will represent the months of revenue we paid for February and March. So there will still be some unearned revenue on the books. Here's the interest. Okay, they bought this. They paid a note. Notice they pay a note for the remainder, 21,000. Expect to last. All right, so they're actually financing 21,000. It's going to be for 5 years. So they have a 6% interest rate. I don't know if you're going to be calculating interest on Chapter 3 quiz or test. Yeah, we'll see it in a later chapter. But if we wanted to calculate its principal times rate times time, so the principal is 21,000, the interest rate is 6%. In interest, you do care more about the dates. They didn't start this until the 6th of it, so we're going to take 31 minus 6 to get the number of dates that occurred in January that we held the note and that we're going to pay interest. And then we divide by 365 the number of days in a year. So interest rates are always yearly rates unless explicitly said otherwise in the contract. So this is 6% not over a month. It's 6% over a full calendar year. 131 interest is going to be, we're paying it, so it's going to be interest expense, interest payable, and it's going to be for the amount we've calculated, which will be right here. I'll show you how to calculate it too. All right, so I want to do what's in the parentheses first. 31 minus 6. We have 25 days. Divide that by 365. Then just multiply by the other two terms, 0.06 and the 21,000. 86. Notice it's rounded, but it's closest to $86. All right, the depreciation one. We should know the two accounts. It's always depreciation expense. It's always credits accumulated depreciation. Always 100% of the time. $24,000 asset, 5 years. So 24,000, 5 years. 3,000 residual. So we're going to take out this residual first. So it'll be 24 minus 3, which is 21. We're going to divide that. You can think of it dividing by 5, but then we need to convert it into monthly terms. So we're going to divide it by 5 and then by 12. I'll show you what it looks like. So you're going to start with 24,000. You're going to take out the 3,000 residual. We can divide it by 5 at first, but this is a yearly amount, right? We need to divide that again by 12 to get it into a monthly term of 350. Hopefully that's what's here. And here's another way to do it. You can just multiply the 5 and the 12, or you can just think of this as being 60 months. All right, accrued revenues. Paul's informed Janet. All right, so they have 2,150 of revenue that has not been collected or recorded. Karen reports that of veterinarian. So the first one's grooming, the second one's veterinarian. Again, we're not receiving the cash, so we have to put it to accounts receivable, and accounts receivable should be hit for the total amount, so the addition of the two, 3250 plus 2150. And the next two should be grooming and veterinarian revenue for the respective amounts for the 2,150 for grooming and 2,250 for veterinarian. So we're accruing the revenue. We've earned it, so we get to recognize as revenue. We don't have the cash, so we have to put it into AR. All right, income taxes. We haven't seen an income tax, but this is an accrued expense. So, accrued expense. So it's going to be like, you can remember wages expense, wages payable, except here it's going to be taxes expense, income tax expense, income tax payable. We can't figure out the amount until we do the rest of it, so we'll have to come back to this page in a second. We need to know their net income. The next step would be to post everything. So you see this is already posted in red for you. Hopefully we have this down from Chapter 2 and we don't need to spend too much more time on it. But all these accounts will be posted, hopefully by the computerized system. And then we make our new trial balance. This would be an adjusted trial balance. The other one we call it unadjusted. In the real world, they don't differentiate. They just call everything a trial balance. But in the textbook, it's nice to, as we do more things, change its name a little bit. All right, here we list out every account and then its balance, whether it's a debit or credit. It would come from the T accounts here. What we're going to do is figure out the income before taxes, and that's nice that it's organized this way because it's just going to be all this information. So these two numbers are a revenue, they're positive, and then all these will be subtracted out. So that's the calculation you're going to see here. Equals 9084. What we're going to do is plug that, go back to the tax table, plug it in. Like I told you, it's going to end up under 50,000, so everything's going to be taxed at 15%. So it's a flat 15% from the table. So 9084 times 15% is 1363. So that's the amount of our adjusting entry. We had to leave that one blank until we figured out their income before income taxes. So that's our amount. Don't worry, you're not going to see the income tax one on anything. Just put it in there. It is useful to know how to calculate net income from a trial balance. Two revenues minus all the expenses here. Since the revenues and expenses are at the end, it makes it easy to calculate. Next page, it shows a worksheet. I'm not sure if we're going to use a worksheet or not, but it's basically a combination of all the trial balance. We see the unadjusted trial balance numbers here. We see the adjusting entries here that we perform in Chapter 3. And then we have the adjusted trial balance numbers that we've seen. We haven't seen the other part, but these numbers effectively travel to the balance sheet and the income statement, and they help you make your financial statement. So it's a useful tool, but it's optional. It's not required. And if we ever do use it, I don't think we're going to have a project or anything that we use the worksheet on. All right, the full accounting cycle. First, we're doing first a transaction happens. It's not really the accounting cycle, but something happens that we need to record. We journalize, post, and make an unadjusted trial balance. So that's Chapter 2. Did these 3 steps in Chapter 2. We're going to then go on to Chapter 3, which we covered today, are these steps. In green, adjusting entries, we post them. We make an adjusted trial balance. You kind of see the trend here. This is just our normal journal entries. We post, make a trial balance. And these are adjusting. We post and make a trial balance. The last step is actually, well, the last part of this, we can actually make our financial statements after we have the adjusted trial balance. So even though it's the output of the system, it's not the last step in the accounting process. The last actual step is a closing process. We do journal entries we're going to see in Chapter 4, which are closing entries, and we post them and create another trial balance called the post-closing trial balance. But these are for the future chapters. All right, we have the too long didn't read page, Chapter 3 summary. You can see some basic definitions of what to know, but for the quiz, I would be prepared to do anything that you see on the homework. So the homework will be the basis for it. There'll probably be a bonus problem related to something else in the notes, but it's a bonus. But to get to the 100%, I would know everything on the homework, which you can see on Blackboard. All right, let me know if you have any questions, and we'll see you guys next time for the Chapter 4 lecture. All right, bye-bye.